Okay, welcome everybody to today's meeting of the Hawaii Tax Review Commission. The first order of business is public testimony. Do we have anybody who is contributing to public testimony today?
The department did not receive any public testimony.
Okay, thank you, Seth. Moving on, approval of the minutes of September 15th. Are there any additions or corrections? If none, may I have a motion to approve?
Move to approve the minutes.
Thank you, Winston. And a second?
Second.
Thank you, Sale. Everybody in favor? Say aye.
Aye.
Aye. Anybody opposed? Okay, motion carried. Now on to our presentation from Dr. Caracavalli.
Good afternoon, everyone. Let me share my screen with you to get started.
Hey, Beth, as Barbara's bringing it up, just as a reminder, the recommendation for the Sunshine Commission is to actually ask everybody individually about their vote.
Oh, okay.
Yeah, just as a reminder.
Okay, I'll try to remember that the next time.
Yeah.
Thank you.
Mm-hmm.
All right, it's my pleasure to talk about two of the issues we have identified, and as I promised that I would be making a presentation on. The first one will be about Hawaii standard deduction and personal exemptions, and the other issue that I'll be addressing today is taxing pensions. And I've prepared a separate slide because I want to make sure it's very clear, the disclaimer that I utilize the data from Hawaii Department of Taxation. And however, any research analysis, any interpretation, any views, opinions expressed in this presentation are my own and should not be attributed to Office of Tax Research and Planning or Hawaii Department of Taxation. So this is my independent consulting work, and I am the one who's responsible for what is in it. The one thing that does happen through my work as an economist in the Office of Tax Research and Planning are the revenue estimates. And those were discussed, and I've gotten feedback and approved by Seth Colby, as you know, is the manager of our office, is the Tax Research and Planning Officer. So to that extent, he agreed me to incorporate the revenue estimates to today's presentation. And I want to start by giving some background and to also put things in context. And hopefully these will help you make more informed decisions. And I'm going to be presenting a few of the experiments, so to speak, that were brought up in Kate's presentation earlier, and we had discussed, and some suggestions that Seth had questions about. Just to begin, the work we're going to be looking at is involving individual income tax returns. And as you know, the residents fill out Form N11, or you may not know if your accountant is completely taking care of these, but hopefully you have heard these numbers before. And the Form N15 is not only for non-residents, but it's also for part-year residents, people who may have moved here during the year or may have moved out of the state. But it also includes non-resident aliens or dual status aliens. One last thing is there are also composite returns that might be filed on behalf of non-resident shareholders of an S corporation or non-resident partners, and we will call this whole group as non-residents going forward. The individual income tax starting point in Hawaii is with the federal adjusted gross income. So that's where we start, and we have a number of subtractions and additions to the federal adjusted gross income. The main ones that we will be looking into in the next topic are the subtractions is, as we have discussed, pension income and Social Security benefits are exempt. So this is subtracted from federal AGI, but we also have additions. At the federal level, the government employees contributions towards their pension plans, the defined benefit plans, are taxed by Hawaii upfront, although they are not taxed at the federal level. So we kind of tax them upfront. And what is left over is the Hawaii adjusted gross income. Now, the Hawaii adjusted gross income has further deductions, just like the federal taxes. There are deductions, and these can be either itemized or standard. I will be looking into standard especially, but I'll talk about the interplay between standard and itemized deductions. There are also exemptions. So these can be personal exemptions taken for oneself and for one's spouse if they're filing jointly, any dependents, qualified dependents that they may have. Also, there is one for being aged 65 or over. Same thing, if it's joint, then it's both you and your spouse. Or there is a special disability exemption, which is much higher. But if one takes the disability exemption, then they cannot take any of the other exemptions. What is remaining from this is the taxable income. So the taxable income is where we apply the applicable tax rates. And what is then left after this is the tax before the tax credits. So once we then deduct the tax credits, which is the tax liability before tax credits, after that is the actual tax liability after credits. So that will be our concern, and that is what is collected and what goes into the state coffers. So we talked about how standard deductions have changed over time, and one thing that that I had brought up was the fact that they do change infrequently because they're fixed by statutes, the amounts. However, if you look at over the years, going back to 1982, when for the joint filers it was $1,000, and in 2013 it came up to $4,400. If you look at the 82 to 2013 average growth rate, that was 4.9%. The average inflation rate in the same period was 3.12%. So despite the fact that there were infrequent changes to the standard deductions, once they were increased, the increases were enough to account for inflationary pressure. And if you, just in case you were wondering, the amount of inflationary change between 2013 and 2020, which was last year taxes were collected, was 11%. So that was roughly the change back in 2013 when they increased the standard deductions from 4,000 to 4,400. So it was a 10% increase. The other thing is that the federal rates, as we've discussed, were overall higher than the state standard deductions. And in 2017, with the Tax Cuts and Jobs Act, they have been substantially increased, but several limitations have been brought into itemized deductions, and all the personal exemptions were gotten rid of. So that's when we see the big jump from 17 to 18. And overall, otherwise, the federal standard deduction amounts were tied to inflation. So they roughly followed inflationary increases every year going forward. The exemptions, on the other hand, the personal exemptions, as we know, were increased only once in 2013 since 1985. And they did understandably fall short of the inflationary increase. So the average growth rate between 85 to 2020 was only 0.27% in the personal exemptions rate, whereas the average inflation rate in this period was 2.5%. So it definitely fell behind. However, at the federal level, as I mentioned, in 2018, all the standard deduction, all the personal exemptions, I'm sorry, were indeed repealed. To kind of look at, okay, how does Hawaii's standard deduction amounts compare relative to the federal amounts every time we had the change? You can see from the table that is in the upper part is that it was roughly about 35, 30, 40% of the federal rates. And if we were to keep the same calculation in 2017, the number could have gone up to, if we were to keep that same ratio, that of Hawaii to federal standard deduction amounts for joint filers. If we were to keep that same ratio, the standard deduction amount would have had to increase to 4,580. And if we were to, again, just pick the 2020 number and apply the same 36% rate, then the standard deduction amount would go to about 8,900. So let's just say roughly about doubling the standard deduction amounts. So this will be built into the to the revenue estimates in terms of the type of changes. The numbers that we're going to be looking at. So the first one is what happens if you double the standard deduction amounts from 4,400 to 8,800. And we will also be looking at what happens if we not only increase them, but also tie these deduction amounts to inflation going forward, just like it is done at the federal level. Another exercise we will be looking at is the tripling of standard deduction amounts. And this is in line with the 2015 and 17 Tax Review Commission a recommendation at the time. They had asked the Hawaii standard deduction amounts to match the federal rates. So this is roughly matching the, the rates at that time. And the last one is trying to match somewhat the federal levels now, but removing the exemptions. That was the other thing that Kate had pointed out, that what if we completely try to mimic the federal legislation and increasing it dramatically, but removing the personal exemptions. So we'll be focusing on these three revenue estimates. And as I said, the work that goes into the to the revenue estimates is done by our Office Tax Research and Planning. And I present these to Seth Colby, and he approves or has comments or changes to this. So it is a joint effort in that regard. But what goes into these estimates, I think is worth mentioning. The one advantage that we have is that the individual income tax policy experiments that we're able to use are able to take advantage of what we can call micro simulations. So we start with the individual income tax returns of 651,000 resident returns and 100,000 non-resident returns. And then the taxable income, as I mentioned, is the Hawaii adjusted gross income minus deductions and exemptions. Then we apply the taxes, but the tax rates, there are 12 brackets. So I'll talk a little bit about them. So either if you have net long-term capital gains, the tax rate is 7.25%. So if you have capital gains, then you pick the one that is lower of the two, whether you apply the marginal tax rate or the capital gains tax rate is going to be different for each individual. So I start with taxable income of each of these returns and apply a tax rate and come up with a tax liability. And I call this synthetic tax before credits. It may or may not be exactly equal to the actual tax liability of the taxpayer. The reason I do this is that because when I do any policy changes, I want to have an apples to apples comparison so that the same methodology is used. So what that means is the difference is we're changing deductions, right? So what you see highlighted in blue here is that we will use the new standard deduction rate. Obviously, we still have to figure out the new deduction based on, okay, now every single individual is facing the following decision. There's a higher standard deduction. Would they rather take that? Obviously, they want to choose what is best for them. Or would they continue to be claiming the itemized deduction? So you have to do this for each and every one of them for the 750,000. And then you apply taxes on this new taxable income. And then that is called the counterfactual tax before credits. It's counterfactual in the sense it's not the real one, but this is what would have happened. And then there are a few little details here. One is about tax credits. So the tax credits, the non-refundable one, is only applicable up to one's tax liability. Since we are changing the tax liability here, we have to also apply the non-refundable tax credits. And if after having accounted for non-refundable tax credits, if the outcome is less than 0, then the person's taxable income basically becomes 0. However, the taxpayer would still be entitled to get their refundable tax credits. So if someone has 0 after non-refundable tax liability, once you apply the refundable tax credits, the person might actually be getting a check from the government in the form of a subsidy. And these would especially be true in the case of the ones that target the low-income groups, the low-income renters tax credit, or food and excise tax credit. These are all refundable. But there are also business incentive tax credits that we had mentioned last time, which we'll get into in a different presentation. And you do the same for all residents and non-residents. So the difference between the tax liability that we come up with and add them up between these counterfactual and the synthetic tax liabilities after credits is the revenue impact. So when we come up with some number, when we say it would just increase or decrease the tax collections that goes to the general fund by 10 million, 50 million, this is the process, the kitchen work, so to speak, that happens. So what are the advantages of this is that it's definitely more precise. And it's using the population of the data and does not suffer from sampling error. And it's detailed down to each individual level. So you're able to apply all those individual situations that might be impacted by this policy change. And we are able to also offer powerful statistical analysis where we can provide not just the amount, but how does it really affect different tax brackets, income groups, filing status, and so on. So let's take a look at the first policy experiment, doubling the standard deduction amounts. And then so doubling them would be the blue column here at the table at the top. And then if they're indexed to inflation using the Council on Revenue forecast for inflation rates going forward for Hawaii, you can see the changes that would happen in calendar year 23 to 9,000, all the way to $10,000 in calendar year 28. And I'm not going to be showing all these numbers because it would make anybody dizzy, but just to show you, we kind of put together that synthetic and counterfactual tax liability side by side. And we have to do the same thing for residents and non-residents who have Hawaii tax liabilities. And the number that we come up with is about a $50 million reduction in the collection of individual income taxes if we were to double the standard deduction amounts. That corresponds to about a 2% reduction in the potential individual income tax collections. And then to kind of look at whether it's indexed to inflation or not, and how do we forecast for future years, what we rely on as our best estimate is total personal income growth rate. And there are forecasts that is done by the Council on Revenues as they meet twice a year about total personal income and 4 times about general fund. So we rely on those forecast figures to project how the income level in Hawaii will change and how that would affect the tax collections. And the other thing is if we index it to inflation, that would also create an incremental increase every year. And that's why a further negative revenue impact over the years. To summarize this, right, the initial impact of the exercise is 50 million, but if we take into account the changes over the years in personal income, the 5-year average, assuming the legislature would get this measure by July 1st, 2022, it would start be effective fiscal year 23. So for the next 5-year average, this would correspond to about 57.9 million of a reduction in revenue collections. And if we index it to inflation, then that is a bit more. It becomes 63 million. Now, so we don't need to do the same details for each one of them, but the tripling the standard deduction amounts was, again, what if we repeated the exercise, as Kate had mentioned, to match the 2015-17 Tax Review Commission recommended, somewhat matching the federal rates. And the outcome from that is about 113.9 million of a revenue impact, which corresponds to about 131 million, if not indexed to inflation, over the course of the fiscal year 23 to 27, or 144 million loss if it indexed it to inflation. The third one is, what if we conform to the federal rules, and this would roughly correspond to increasing the standard deduction amounts 5-fold. That is going from 4,400 to 22,000. But at the federal level, since the exemptions were removed, so we're removing exemptions. The one thing that they did, though, is that they have this additional $1,300, or if it's $1,650 or single, of additional standard deduction for old age and disability status of the self or spouse, or spouse. So conforming to the federal rate, trying to mimic what is happening there, the revenue impact is $184 million. So these are the total amounts. This is the summing up every single individual who's paying taxes, and kind of assuming, obviously, tax year 2019 is a good representative of the composition of taxpayers going forward. There might be slight changes, but this is a best estimate that we can come up with. Another one was suggested by Dr. Colby, that what if we just purely look at indexing the standard deduction to just the inflation, right? Just let's keep the same rate, but just indexing to inflation. What is the really cost of that? That would be about $3.5 million with an average of 4.4 million from 23 to 27. I will like to talk about, okay, so these are the totals, but what is the impact? I mean, what does this really mean? So I want to take a step back and kind of present a bit of distribution of taxes and how does this affect the tax liability of different groups of Hawaii taxpayers. I want to just bring you up to speed with parts. One way to kind of make it an apples to apples comparison would be there's different tax rate. There's the same tax rates, but applied to different levels of income, whether you're filing as a single person, head of household, or married filing jointly, or a qualifying widower. So if you look at the first part of this, the 1.4% tax rate applies to, if you're single, up to $2,400 of income. But if you're joint, these numbers will be doubled. Similarly, the 3.2% will be applied to the income between $2,400 and $4,800 if you're single, but it's going to be double that if you're filing it jointly. So there are some advantages to filing jointly if one of the spouses have a relatively less income, and they would effectively be subject to, at the personal level, at a lower tax rate. No, so what is the marginal tax rate? What does that really mean? This means that you're not taxed at a flat rate. Let's just say you make your income is $10,000. You're a single person. You would look at this table and you would think, oh yeah, I'll pay 6.4%. No, that's not how it works. You're actually taxed at 1.4% for the first 2,400 of your income. Then the next 2,400 to 4,800 of your income is taxed at 3.2%. So what happens is that each additional dollar, that's what is meant by marginal, each additional dollar that you might have is taxed at this rate that you correspond to. But anything in between is subjected to lower tax rates for these different ranges. What then this means is that when we think about effective tax rate, which is how much taxes do you really pay? So let's say you were, your taxable income was 10,000. It's not going to be equal to 6.4%. It's going to be something less than that. So the effective tax rate is going to be less than the marginal tax rate, and this is due to the structure, the progressive tax structure of Hawaii taxes, which is the same at the federal, but we have more brackets and in effect, somewhat more progressive approach to individual income taxation. Let's take a look at, so the one advantage of this, as I said, is that because if you look at just two tax returns, right? One is joint and one is single, and the joint one has $200,000 of taxable income and the single one has 50,000. It's not comparing two people. It's one is 4 times, doesn't mean that the other couple is 4 times richer. That couple might have 10 kids, and that does not say much. So to make it comparable, we can look at the tax bracket level and just look at, regardless of the filing status, what tax bracket they fall into. And with that, in a majority of the taxpayers in Hawaii are in the first marginal tax rate bracket. 20% of them are here. Part of this is obviously, as we know, pension income and Social Security benefits are exempt from taxes. So their taxable income would be lower than what their federal income would suggest, which we will discuss in the other topic. But the second group is the majority of the taxpayers are in the 8.25% tax bracket, and they pay the majority of the taxes, about 40%. So what is 8.25% tax bracket? Okay, with the arrow here. So this is kind of a very wide range. So if you're making anywhere between 48,000 to 150,000, it's no surprise that this would be the majority of the taxpayers paying the majority of the taxes. The other thing to note is, how about based on income distribution? So one measure of income is a federal adjusted gross income, which does take into account Social Security benefits that are taxed at the federal level and the pension income that are taxed federally. And what we see here is that we have a different picture, right? It's all of a sudden, it's not the first tax bracket, which has the majority of the taxpayers, but actually we have the 50,000 to 75,000, where majority of the taxpayers are. So 15.1%, the highlighted cell in the second column indicates that this is where majority of the taxpayers are. But who really pays the taxes is that the 400,000 and over federal income class represent only 1%. So this is the top 1% of taxpayers in terms of their federal income. They pay majority of the taxes. They pay 25.7% of the taxes, given the progressive structure of taxation in Hawaii. Another thing, how about the distribution by filing status? The resident taxpayers, majority of them have single filing status. However, it's no surprise that the joint resident filers carry the majority of the tax burden. So they pay 61.8% of the taxes, but the typical majority of Hawaii resident taxpayers are single. Now let's take another step back and talk about standard deductions and also itemized deductions. So who uses these? While itemized deductions are mostly utilized by middle and top income classes, standard deductions are used mainly by lower income classes. So the first part of the of this is that I want you to focus on two things. The yellow highlighted figures are the highest figure in a given column, and the blue ones are the second highest. So this is what I mean by majority of the itemized deductions are in the 50,000 to 75,000 range, and the amount in terms of the amount of the itemized deductions, the majority of them are in the income group of 100 to 150,000. When it comes to standard deductions, the top groups happen to be between 10,000 and 30,000. So mostly the lower income, it's utilized more by them. Not only that, I mean, as we've discussed, in 2013 was the last time standard deductions amount were increased. So over time, the standard deduction use has declined, starting at 47.5% in 2013, the darker column, down to 44.3 in 2018, before rising slightly in 19. What does that say? Well, not only that, the itemized deductions are mostly claimed by middle to top income classes, it's also, in terms of the amount, it represents the biggest amount of claims. So if you look at here, the itemized deductions amount to about $6.3 billion versus the standard deductions, which is $800 million. So this is basically 88.7% use currently, the itemized deductions. So one of the things that I'll be showing to you is that what happens if we change the standard deduction amount? Do more people switch to standard deductions? Who are the people who switch to these? What are the distributional effects? The most commonly claimed, I mean, let's also understand what is the itemized deductions, is the taxes paid. And the highest amount claimed is for interest expenses. So what are these things? Well, these itemized deductions have certain limitations, so only certain people can use them. For instance, the medical and dental expenses, there's a threshold. You can only claim these expenses about 10% of your Hawaii AGI. So since the Hawaii AGI of older people are relatively low because they're tax exempt, right? Their pension and social security benefits are tax exempt. They are more likely to be the ones using these, itemized deductions. And they're also more likely to be, unfortunately, using the healthcare system and having these expenses. So it's no surprise, as we will see, that that will be the distribution. Taxes paid deduction. So this includes the taxes that we pay to Hawaii. That's a deduction. So this is also at the federal level, but there's a limit, there's a cap due to the 2017 Act, and the amount of state taxes that you paid were basically used as a deduction in federal income taxes. Now they're capped at 10,000. So the income limit is that if you actually have federal adjusted gross income over 100,000, you cannot claim this deduction. So we will see the impact of that. So medical expenses, as I said, will be taken mostly by lower income classes, but this is by Hawaii AGI, which means that it's probably going to be mostly older folks. The taxes deduction is taken, the second half of the column, look at the highlighted parts, is taken mostly by low to middle income classes, given the income limits. So if you're making above 100, if you're single, you cannot claim this. You can still claim the property taxes. So the taxes deduction includes either the state income taxes that one pays, but it also includes property taxes. So they might still be able to claim that. But when it comes to interest expense, this is the payment for mortgage interest and whatnot. So homeowners would be, it's no wonder that this would be mostly claimed by middle income classes. However, charitable contributions and casualty losses, these are most frequently, although claimed by middle income classes, the largest is by the top income earners. So the charitable contributions, if you see, 60.9% of the amount claimed are by the top 1% of the population. Now, so let's start with the change in the standard deduction use that these different policy experiments would make. Normally, in 2019 data, 44.7% of the taxpayers did use standard deductions, which means the remainder used itemized deductions. When we look at the new percentage of standard deduction users under these three scenarios. So doubling, tripling, or increasing them by fivefold. When we double them, if you look at the bottom row, the percentage of standard deduction users goes up to 61%. If we triple the standard deduction amounts, the usage goes up to 71%. If we increase them by fivefold, they increase to 83%. So there's a direct correlation of how people would choose to use standard deduction versus itemized deductions. And this is, again, utilizing the fact that you compare, they have to pick whichever one is going to bring them more deduction. The standard deduction becomes more preferred. Essentially, what happens is all the income classes, apart from the joint filers, actually normally have more than 50% standard deduction claimers. But even the joint filers, become, in the fivefold scenario, 74% of them do use standard deductions after this policy change. And this is especially the largest for the joint filers, right? They are the ones that are more likely to use itemized deductions, but they have the highest switch rate as compared to the other taxpayers who are already using quite a bit of standard deductions. In terms of the division of the income levels, though, the broken down by the tax brackets, the percentage of standard deduction users are less than 50% for middle to upper tax brackets. So the first highlighted column under the percentage of standard deduction users, I highlighted the columns that are less than 50%. So these are concentrated in the upper income. So the upper income is more likely to claim itemized. And then the only time that this upper income classes also exceed 50% mark is under the fivefold increase. But in all the doubling or tripling, their usage does go up of standard deductions, but they still remain under 50%. The next one is about, okay, how is the burden of this, not burden in this case, how is this reduction affecting, right? How is the benefit of this reduction in tax liabilities distributed in different tax brackets? Well, what I have here is the net tax liabilities of each and every one tax bracket. And the highlighted ones are the only tax brackets where the tax liability share of these brackets increase under the new policy scenarios. So what does that mean is that the tax liability share of these upper brackets increase because they are more likely to continue using itemized deductions. So they do not get to take advantage of necessarily this increase in standard deductions. So, and this will be the mechanism with which that everybody has overall, each tax bracket has a reduction in the net tax liability. So if you look at the first part, change in average net tax liability, and look under the column of doubling the standard deduction amounts, on the average, these are dollar amounts. So $72 is the average reduction of a taxpayer of their tax liability after we double the standard deduction amounts. It's $267, the bolded last row, under fivefold increase. However, these changes are broken at different amounts by different income groups. So what happens is that the percentage reduction is disproportionately higher for lower tax brackets. That is, since the lower tax brackets are the ones that are more likely to use the standard deductions, the impact is more effective as a percentage of their tax liability. However, you should also realize that their tax liability is relatively less to begin with. So if you just look at the values of how much reduction occurs, the higher tax brackets also get a reduction in tax liability because everybody is eligible. This is not based on income level, But since the lower tax brackets are more likely to use standard deduction and take advantage of this, the impact is has a bit of a sign of progressivity when we increase standard deduction amounts. The if you look at different filing status and the tax liability share of joint filers increase, and because they're more likely to continue using itemized deductions. So just like what was happening with the income groups, the top tax brackets were more likely to continue using itemized deductions. The same is true for joint filers who tend to be older and might be homeowners and will have other itemized deduction availabilities. The percentage reduction in tax liability is disproportionately favoring the unmarried people in this case. Now, just summing up, as I mentioned, if we were to just if our concern is just falling back behind inflation, the amount of change that would be called for is somewhat over 11%. If our concern was potentially retaining the same ratio of how we have, attained the Hawaii standard deduction amounts relative to federal rates, and if we were to match the 2020 rate and keep the same ratio, it would be roughly doubling it. If we were to match the 2017 rate, it would be tripling it. And if you were to complete the match and conform with federal, it would be kind of roughly corresponding to increasing them by 5-fold and removing personal exemptions. And these would be the revenue outcome of such change. Any questions so far? I know I've been going so far. I've been going for a while now, and it's impossible to keep one's attention for this long. Any questions? Any so far? There's one more policy experiment that Dr. Colby had suggested, is that he was curious about seeing what happens if we just index the tax brackets to Hawaii inflation, right? This is one thing that is done also at the federal level. What happens is people's income obviously keep increasing by inflationary pressures, but we do not change the tax brackets. And then what happens is that they get creep up to higher tax brackets and end up paying more taxes every year, even if nothing else changes. By the mere fact that the nominal wages rise, by keeping the tax bracket values the same, we collect more taxes every year. So what that would correspond to, let's just take the Council on Revenue's forecast, and that averages to 2.2% for the next 8 years or so. Let's apply a 2.2% increase just to see what that would correspond to these brackets. So the 2,400 threshold would become 2,451. So you would be paying 1.4% up in this amount. So overall, the tax liabilities, as you can expect, is going to go down. But how much? The total tax liability goes down by 8.9 million. And then using the inflationary forecast as a measure by Council on Revenues, this would be on the average about 11.4 million between 23 and 27. And what is the impact, right? So, okay, I mean, yes, the total dollar value is obviously important, and we want to know what the impact will be, and any recommendations are made. But I think what would be really helpful is that to dig a little deeper and see the impact, right? Because the Tax Review Commission is tasked with looking into equity and efficiency as one of their concerns, as two of their concerns. What would be the impact? So in this case, as you can see, the biggest percentage change in net tax liability is in the lower federal AGI classes, and it's proportionately less and less for lower income taxpayers. So in effect, Obviously, this does lower everybody's tax liabilities, but proportional to their original tax liability, this is even more so for the lower federal AGI classes. At this point, let me take a moment and see if you have any other questions. Otherwise, I will be moving on to the next part of my presentation, which is about taxing pensions. I mean, I know there's a lot to unpack. These slides will be available to you, and you can take a look at them and see. You might have other detailed questions that might come up. But I wanted to kind of have a first pass at these, and then in a more formal way, these will be the foundation of the appendix chapter that I will be writing as well. So there will be much more information and references in there. But I think in terms of the policy suggestions that eventually Tax Review Commission will be formalizing, I think providing this presentation hopefully sets the stage for some of the recommendations that you might have.
I want to thank you, because that obviously you have done a lot of work on that, and it's really very helpful. But I'm just wondering if there are no questions on the first part, whether you would mind very much if we change the agenda a little bit to have the discussion about green fees next, and then we'll put you back on, just because we probably don't need to have Dr. Kittinger and those folks who want to talk about green fees listen to. I mean, you know, everybody should be interested in income taxes, but nonetheless.
Thank you.
Yeah. So with that, Dr. Kittinger, are you going to be sharing a presentation with us or highlighting the additional information? The floor is yours.
Thank you, Chair, and thank you for that graduate seminar on taxes. I appreciate that. I learned a ton. I'm going to try to share my screen here. Let's see here. How's that? Does this work? Okay. Just play from the start. Can you guys see my screen?
Yes, and you're in presentation mode, so all's good.
Great. Okay. Well, we sent our memo over, and by we, I'm representing, together with me is Eric Coe from the Harold Cale Castle Foundation. We have a team of folks from a range of organizations, so I'm just the representative here of a hui of folks. So we sent a memo over to the Tax Review Commission on Monday, and I'm just going to walk through that very quickly. I only have a handful of slides, and then we can open it up for discussion. Does that sound good?
Yes, please.
Okay, wonderful. So the memo focused on several elements, and I just want to say that it's a brief memo and it draws on quite a lot of research that has been performed over the last, I'd say, 4 to 5 years. We put references to the source material in the memo. The original report itself is dozens of pages long, and we're trying to essentially provide an abstracted version of that to the Tax Review Commission. But of course, the full weight of that material is there, should it be of interest. We've also done a legal analysis and analysis of the green jobs landscape and several other things that we can provide if there's interest in that. So in any case, we start by looking at the policy options that are available for establishing a visitor green fee in Hawaii. And we've laid them out. There's essentially three options. They have their different policy elements. To walk through them quickly, the first option is the TAT, or the Transient Accommodation Tax, which everyone is familiar with that. A lot of changes to the TAT due to the last legislative session and the passage of House Bill 862. Now the counties have the ability to establish their own TATs. The County of Kauai has just done so. The County of Maui is expected to do so very soon. And I think Oahu is also expected to pass their own TATs. I understand there has to be some tax infrastructure put in place for those counties to aggregate that and collect it. Maybe Seth or others would know more about that. But in any case, essentially that creates two ways to do a green fee using the TAT policy. And that is, you could either carve out a portion of the TAT, either at the state or county level, or you could top up a TAT. Those would both require legislative actions, either at the county level or the state level. The state TAT is at 10.25%. All of that was diverted into the general fund last session, but there will surely be a discussion next session about that, because some things that have been historically funded by that will need to probably come back to that funding source, including the Hawaii Tourism Authority, for example, which was funded by federal stimulus funds last year. And then, of course, the TATs at the county level can be up to 1 to 3%. And I've got these arrows in here to indicate if you are to either do a carve out or a top up from the TAT, where the funding would go. We'll get into that in a little bit more detail in a moment. But essentially, it changes based on which jurisdictional scale, either state or county level, you establish this carve out or top up at. Now, policy option 2 is far more common in other geographies, but far more complicated in Hawaii. And it's legally viable, permissible to charge both residents and non-residents, visitors that is, for use of natural resources. And in fact, we do that all around the state at different levels for entry into places like Hanauma Bay and such. The jurisprudence and the litigation that's happened with respect to this issue in Hawaii suggests that you could indeed do that, but the problem that you run into is how you would collect an environmental fee. You essentially cannot make it an entry fee because you will run afoul of constitutional issues. We had a pretty significant legal analysis done on some of those issues, so we've looked at those dimensions. But you could also perhaps get around it you could perhaps collect it by making it a permit or a license of sorts, because we often do that, both here in Hawaii and in the United States. So that is a legally permissible option. So this is something that is possible, but you would have to thread a narrow pathway with the collection method to make it legally viable. We've got revenue estimates for both policy option 1 and policy option 2, kindly prepared by Seth, which I'll get to in just a second. But before doing so, there is another potential option where you could add, for example, $1 onto an entry fee that exists for managed sites across Hawaii. So think of Hawaii's Volcanoes National Park or Hanauma Bay, or any number of federal, state, and county parks where we already assess fees, and you could potentially add $1 on top of those site level fees. You would likely have to restrict that funding to those sites, but that is another way that you could potentially create a site level green fee system. And I will just say here that the fundamental difference between policy option 1, the transient accommodation tax, versus policy option 2 and the site-based green fees is that the TAT is a true tax, meaning you can use it for a broad array of functions, meaning it's less restrictive in its use. And that's, of course, indicative in how the TAT has been carved up and distributed in the past. But the other two options are fees, meaning that they are collected for a purpose and therefore must be used primarily for those purposes. And that has, there's been litigation on Hanauma Bay's fee schedule, for example, that requires that fee to be used at Hanauma Bay only. The last thing I'll just say about this is that it is perfectly viable and permissible to charge residents and visitors different rates. We do that with things like tuition at the University of Hawaii and other things. So that is also a possibility to differentiate and discriminate between residents and visitors. So we can talk more about some of the ramifications of that if it's of interest. This is the biggest part of the memo we sent. Here are the revenue estimates. They are underpinned by some assumptions on visitor arrivals and repeat arrivals. Carving out or topping up 1% of the state TAT. This is the state level because counties don't have their TATs programs established yet, even though Kauai has passed its TAT recently. This is the annual revenue in millions that it would produce, and Seth, you can jump in here, but it's quite a big number, you know, starting around 42 million and aggregating up as visitor numbers increase over the next half decade or so. The $50 per person, you know, if we were to do this in the form of like an environmental permit or something like that, produces far more revenue and would be far more consequential, you know, starting around 370 and moving upwards almost to $500 million per year. And this is much more, I would just say this is a much more common approach that other geographies use. But as I mentioned previously, it's much more difficult in Hawaii because of the constitutional issues that it creates. And the collection method is key to that. I'll just cover very briefly two other elements that we touched on in the memo because they have been front and center in our research. The first is how would you manage and distribute the funding that is the revenue that's generated. And we didn't create a comprehensive briefing on these elements of it, but these are some core elements that are key to the overall kind of policy and fiscal, I guess, landscape with respect to a visitor green fee. And you can see them here. You know, first you have to have a special fund, whether it's at the state or the county level, obviously to aggregate the funding. Often, you know, there's dozens of special funds in Hawaii. Those were also the target of a lot of action last legislative session. So there's a dynamic landscape there with respect to spending ceilings and other elements to be considered. Many special funds are actually mixed with other sources of funding, for example, federal sources of funding that kind of co-encumber the revenue that the state provides. They can also be matched. The private sector currently puts in a lot of funding towards conservation initiatives, so it could be a matching vehicle as well. There's a lot of different models for how these funds are managed. I actually sit on the Palau Protected Area Network Fund Board. So which is the board that manages the green fee funding in Palau. So I've gotten a firsthand view of what that looks like. But the model that seems to work best in most places is a public-private partnership model. And what that simply means, and we do this here, for example, in the Waikiki Beach Improvement District, is that the fund itself is managed by a consortium of both public and private thought leaders. So in this case, you could easily imagine that, you know, the chair of DLNR and DBAT and other relevant public agencies would be on the board along with some private sector leaders from the conservation community and the tourism sector. And then lastly, another key element is that often the fund itself and the board issues annual reports to indicate what was funded and the impact of that funding. That is an accountability and transparency mechanism that also is noted as being very successful in other geographies. Last, I mean, this is very, very brief, but there's a lot of potential for this. We have a huge unfunded liability with respect to our environment, and thinking about that as our green infrastructure, just like a pension liability is a real thing, so is our liability with respect to our environment. We've set some ambitious statewide targets, and these were front and center when Governor Ige invited the world to Hawaii for the World Conservation Congress in 2016. Eric and I were front and center in that whole discussion about what Hawaii would do, as it invited the global conservation community to our shores 5 years ago now. And the World Conservation Congress, which is sort of the Olympics for the conservation movement, just finished its meeting in Marseille, France last week. It was the first international convening since the Hawaii convening, where we established our 30 by 30 targets. These are ambitious targets. We have not made much progress, and mostly we have not made much progress, not because of lack of will, but because of lack of financing. So this could create a financing mechanism for these targets. It also is offers a lot of impact potential with respect to green job creation. This is how green fee funds are used in many other geographies. They support jobs and economic diversification in the economy. We've pulled together a green jobs assessment and what a green fee fund could do with respect to that. So we have a pretty clear-eyed view of the green job creation potential around that. And that part of our economy is an innovation sector, and one that is growing year over year. So it is a strong thesis for investment for economic diversification. And then lastly, we have a lot of things going on with respect to how our tourism sector is evolving, and especially community concerns about visitors and the role of tourism in our communities, in our economy. There is I think it's fair to say, very vibrant discussion going on about how to reshape, reimagine, and rethink the tourism sector. And obviously this creates a mechanism for visitors to become part of that solution and giving back to communities. So with that, I will end, and I will welcome any questions, and Eric and I will try to answer them to the best of our ability.
Hey, Jack, can I jump in and just like I was teaching, like, so I teach econ the other day, and I was like teaching, and I did some teaching that I think would help inform on this analysis. Do you mind if I just show my screen real bit and
Sure,
real quick?
sure.
Yeah, thanks.
Go for it.
So one of the things I was, let's just do this one, thinking about, and you guys can see my screen all right?
Not yet.
Yep.
There you go.
Yeah, no, okay. So one of the things that we kind of were really,
Seth, I'm sorry, can you put it in presentation mode?
yeah. There you go. Is that okay?
Yes, good, thank you.
Perfect. So one of the things that we're always concerned about is who pays the taxes, right? And so one of the things that we know from just general economics, so this is we can make an informed guess about who's going to pay a tax just by looking at certain characteristics of the market, right? So this is your general supply and demand graph, right? And one of the things that, if you guys remember from your first year economics courses, there's elastic and inelastic goods, right? And so inelastic goods have like generally more vertical shapes like this, but we also can tell, and inelastic means that like something, the inelasticity of supply means that the supply doesn't really change much with price, right? So one of the things that we do is we know that our hotel stock is basically fixed, right? And so that does not change much with price. We can start talking about, you know, vacation rent or Airbnbs and stuff, but let's just make it simple. And so when you impose a tax, right, you're creating a divergence of the price willing to be paid by the market and also willing to be supplied, right? And so one of the interesting things that you can just do is look at like who's paying the brunt of the tax. So C and D, this area, this is the tax collected by the state, or in this case, the green fee, if we're thinking about it, right? And one of the things that you can do is you're like, okay, who's really paying? Is it the consumer? So all the consumers would be above this line and the businesses would be below this line, the suppliers, right? So you can kind of see when you have inelastic elasticity of supply, the people who are going to be paying the bulk of the tax are the suppliers. So one of the things that we've been talking about with TAT and different things is when we raise it, who's paying the tax? And from this analysis, again, there's a lot of assumptions, and normally you would have to do some empirical analysis, but we've you heroes tried, everybody's tried, and they don't know, but like essentially it's a hotel. When you raise TAT, it's hotel owners who pay the price, right? And that's because they're willing to provide that good at any price, and the consumer is more price sensitive about what they're doing. The other thing that we're trying to do, or one idea, and Jack, tell me if I'm wrong, but we're actually trying to reduce tourism by this, right? We're trying to impose a tax and say you're using it. We want to boost up the price so people do less. The other thing that we see is it affects quantity a little bit, but we wouldn't expect quantity or the amount of demand reduced considerably, right? So this is just a really quick exercise, but something to think about. Like when you're trying to decide between the TAT and a green fee, the TAT is more likely to go mainly to the profits or eat into the profits of the hotel owners, whereas a green fee is probably going to be, this is just for hotel taxes, right? So it'd be a different profile. So I just thought I thought it was kind of interesting, so I thought I'd share it with you, and I hope you don't mind me doing that.
Yeah, thanks, Seth. This is fascinating. I mean, there's if you sort of slice the tourism sector broadly into 3 bins, which is a very coarse way to view it, but you look at transportation, right? That's all the air carriers, the cruise ships, and Roberts busing, that sort of thing. You got the hospitality, which is like the hotels, right? And where you stay. And then the activities, right? All the tours and the things that people do. The TAT clearly, only falls in one section of the tourism economy right there, right? It falls on where people stay, and that's a collection methodology issue primarily. You can't put a you could not put a green fee directly on an airline ticket like Palau does. Like I'm getting ready to book a trip to Palau to go work on things there, and it will literally be on the ticket price that I pay for United. But there's constitutional reasons why we can't do that, and there's a federal law called the anti-head tax that prevents anyone from doing that anyway. So the TAT mechanism is very interesting because that obviously comes into this, you get into this political debate about how much is too much, and whether it's the same debate that happens with rental car fees as well, right? But it is a mechanism that exists, and I think that in this upcoming legislative session, it will certainly be a vibrant discussion about how it's allocated currently, irrespective of a TA, about green fee allocation of it.
Yeah, thanks, Jack, and thank you quickly for allowing us to continue this conversation to the commissioners. Seth, I do want to point out there is a pretty big assumption there that the move here is to control visitor numbers. I know that the green fee is a really big thing, so it's going to be a lot of things to a lot of different people. I do want to say pretty clearly that I do not feel that this should be a mechanism to control visitor numbers. I think this is more about solvency. I think right now the liabilities that we're facing with our natural asset base far exceed the health of that asset. And what we need to do is strike a greater parity between investment and return, frankly. So I know that that's always a really tough needle to thread, particularly with legislators. It's this idea of, are we controlling tourism, or are we mitigating the impacts on our environment from all of us? And so I'll leave that out there for people to consider and talk about. But for me, that's a really, really key point and distinction to try and make.
That's right. That's a great point, Eric. And in our review of 12 different visitor green fee systems globally, there's not one of them that was implemented, as far as we can tell, and we did interviews, in order to manage numbers of people.
Thank you. And I appreciate both you, Jack, and Eric coming back and presenting some more information for us. Anybody got any questions or comments? Murray?
Yeah, just as I think about the presentation some more, it seems like the best way to do it to avoid misappropriation of those funds is with the fee approach rather than the TAT approach. And it also gives you more money, at least that $50 amount. Of course, it doesn't necessarily have to be $50. The problem that I see with that is it sounds like it would mostly, unless you found a way to do it as a permit, it would sound like it would mostly be location based. And the vast majority of our sensitive environmental assets are not managed sites. So, sure, you cover volcanoes, you should cover Hanama Bay, but you're not going to cover any of the hiking trails in the Ko'olau watershed, right? Because none of them are managed or whatever. A lot of those nearshore fisheries, the beaches and everything else. So there's going to be massive loopholes unless you find a way to get a fee on every site. And if you start trying to charge locals to go to their own beach, you're going to have the pitchforks and torches coming out really quickly, and maybe for good reason. So I like the fee approach. It seems more defensible. It could potentially raise more money. It's more tied to protecting the actual asset, but the lack of managed resources versus the 30% of watersheds and nearshore fisheries, there's not a good match there. And that's the thing that concerns me more. So just happy to hear any comments you have on that.
Yeah, thanks, Murray. Jack, you want me to take a swing at that first?
Go first.
I tend to be far more fascinated by the fee approach as well. But we are learning as we go. To a few points, considerations that you put out there. As Jack mentioned, there is very, very well established precedent for varying fee schedules based on essentially market segment. So you have a non-resident price, you have a resident price, which could be in theory zero based on taxes that they already pay into the system. You could also, particularly with fees and licenses, you can also tap into social welfare programs so that the demographic below a certain income doesn't pay for it regardless, which I think has shown a lot of utility in other states with their licensing programs. One thing that we've learned in kind of in real time is an ingredient to this recipe that really is on its own timeline is a legal analysis of what permissions already exist through DLNR and other departments and what permissions are still out there that need to be covered. And I know this is outside the purview of the Tax Review Commission, but it might interest you to hear that, part of that is an exercise in looking at all of these permissions that currently exist through all of the divisions of DLNR and more, and understanding how and why those permissions fall into kind of these certain jurisdictional limitations. The problem with these jurisdictional limitations is that no single entity or department or division is collecting data that's actually useful for managing the resource at the scale at which it exists. So in and of itself, it seems like a very practical exercise to do this, to look at all the permissions that exist, understand where the pukas are, and frankly, fill them, and then understand what data can be collected for the benefit of not only resource management, but also visitor management and experience. But that said, all of that said, pursuing a fee approach will have to include that kind of analysis. I think, well, I'll leave it at there. Thank you. I hope that answers a bit of your questions.
And beyond your own work or your organization's work, there has not been a state-funded study of a green fee or green tax like there was for the carbon tax. Is that correct? This has all been your own work. No state-funded study or anything has taken place yet.
Yeah, that's correct, Murray. We the analysis has all been privately funded. I will say that I think we had a pretty good chance of getting state funding allocated to this in the state legislature in, I guess it was 2020, the one that was disrupted by the pandemic. There was a bill progressing through that was essentially going to allocate state funding towards doing what we've now done with private funding, but also forming sort of a task force of thought leadership from the conservation and tourism and public sectors to co-learn, I think, together about it. But yeah, I think you've hit the nail on the head with respect to the attractiveness of the fee versus the TAT option. And there was a bill in last session that proposed to put a per night flat fee on every hotel stay. So rather than having a percentage carved out of the TAT or topped up, that it would be, you know, $5 or $10 a night per person, a flat fee. I mean, if you go stay at, you know, one of the resorts in Kona, you're going to pay a $35 a night resort fee for internet and towels at the pool. So not everyone stays in those places all the time, but I think it was Seth and others that smartly pointed out that while that sounds very good, that also would require some new tax infrastructure because the percentage thing has got a collection method, but a flat fee does not. But you could envision something like that that's sort of a hybrid between those two models as well. And other places do that.
I'm wondering whether it is also feasible to, starting out anyway, think about a TAT carve out or top up, and also some sort of fee, understanding that right now the infrastructure to collect fees might be extremely limited.
It could be. One of the things that's sort of interesting about our current landscape is that my understanding, and correct me, there may be people on the commission that are, I suspect, much smarter about these things than I am, but that our current Safe Travels program exists through the executive authority under emergency proclamation powers. So right now we require people to, when they're coming to Hawaii, to access that system, upload their tests or not, or upload their vaccination card or not. And that if that is going to become a permanent part of our landscape following the pandemic, that would have to be passed into law. I think that it rests with this emergency authority that the executive branch has currently. But in that is sort of an interesting opportunity because we sort of intercept visitors in some interesting ways right now. Everyone's filled out the agricultural form, right? So when you come to Hawaii pre-pandemic, you had to fill that form out. You still have to fill that form out, except you also now have to do Safe Travels. And if Safe Travels becomes a permanent part of the landscape as a visitor management tool, there could be all sorts of opportunities associated with that. And I imagine it would also have to thread some constitutional issues with respect to interstate commerce, equal protections, et cetera. So that's something to watch, but I think you could probably make the case that the collection method could exist via a program of that kind. And the last thing I'll just say is that in the very earliest stages of the pandemic, when the state and the counties did not have an alignment protocol yet, the Kauai County mayor proclaimed a $50 visitor beach fee that was very short-lived, but at that time, the counties were just sort of doing their own thing before the governor's office required the counties to come in alignment with the state authority for all the emergency proclamations, that this was sort of tried and they didn't have an infrastructure for it. In fact, they were collecting the fee apparently through Eventbrite is what we learned, which is sort of hilarious if you think about it. But some things were being piloted in the early stages under that emergency authority.
Yeah, and I also want to just point out that there's tons of ways to get creative here, right? I mean, you could leverage an additional 2% of GET on like a bunch of items that you think are not umbrellas or things are used for different ways, using for beaches, right? Like what you really want to do is you want to combine like the administrative capacities that exist, right? Because what creating whole new taxes has, you're not only facing political hurdles, you're facing bureaucratic hurdles because bureaucrats don't like to do new things. And yeah, and so thinking what you really want, the sweet spot is figuring out something that's like administrative, you can administrate it and getting to the best way you do. And there are more, think about the GET and certain, the legislature can tax whatever they want, right? So if they wanted to tax all beach gear for like another 20% or something, they could do that, and that could go to a green fee as well.
Well, along those lines, if there are other mechanisms that the commissioners and other folks in your orbit are aware of that we're not considering, we are all ears. Because I don't think, Eric, I don't think we've ever talked about the GET, for example.
I'm not smart enough to talk about the GET. I appreciate that, Seth. I mean, I think there's a lot of opportunity here to think creatively. I do think, Murray, to your good question, that a state-supported study to carve out the specific goals of such a fee or tax, and then how it would be exercised would be really important, because it exists on a lot of dimensions, right? I mean, there's, like, to Seth's really fascinating analysis, and Seth, I hope you don't mind, I did a screenshot of it. Like, there is this fixed supply kind of dynamic when it comes to where people are staying and what that means for visitor numbers. But if visitor numbers need to be controlled, and that's a different hammer and a different nail we're trying to tack down. But if that needs to be done, what are the tools that we find for that? If what we're after is to be more liquid in the way we deal with current environmental management shortages now, as well as bond for future needs, we just for the foundation, we provided a grant to look at what some other cities are doing in light of climate change. They have to raise streets in Miami. There's a whole social program to deal with flooding in Charleston, South Carolina. There's efforts in Boston. These are multi-million dollar programs. So where is that going to come from? I think if that's one of the goals, then again, we need to explore the right tools for them. So and then there's the whole, as Jack was alluding to, and thank you, Jack, there's a whole visitor experience management aspect to this that needs to be thought through. Fortunately, I think there are soft landing spots for this. HTA is well aware of this conversation. HVCB and their Malama Hawaii marketing campaign is paying close attention to this conversation. I do believe we have the right folks leaning in on this, but doing an analysis on the practicalities of what this might look like and why, I think, is still in front of us.
And I'll just point out that the state and counties have more money than God right now for like earmarked because of COVID funding, and they don't know how to spend it. So if you can come up with creative ways of tying this into COVID, a lot of the state agencies, not the Department of Taxation, but a lot of state agencies do have money that they need to spend in the next 2 years.
Well, the conservation community would be overjoyed to help the state spend its money. And I mean, this is honestly where the green jobs thesis comes in, because we still have, I think, the highest unemployment or among them in the US. So thanks for that heads up. I know we're talking with Chair Case soon and the leadership of the DLNR. And thank you. Well, is there, as far as next steps with the commission, Beth, we would be happy for the commissioners to provide comments on our report and to revise it if that's helpful. If there's other things that we're leaving out, or we can let the report stand on its as it currently is. Like, what are the next steps, if any?
So yeah, that is a good question. First of all, does anybody have a question or comment today that we want to add? And then we can talk about how we move forward with this report and any other additional follow-up.
I'll just add really briefly. I think it's already kind of covered in the report, but just to more clearly draw out the trade-off between the TAT being more administratively simple to apply, yet, and you don't want to say this in a way that obviously insults legislators, but more likely to be misappropriated because special funds are easy to pilfer. versus the fee, which is harder, it's easier to defend, but it's also administratively probably more complex to apply. So I'd comment on that. I would also say that if we do go down the route of recommending a study for the green fee, that it might be helpful to think about a scope of what all that should cover, from administrative options, collection options, and some of the stuff that Eric, you mentioned that hasn't been fully researched between departments, and how that could all be applied. Because recommending something new is hard enough. Recommending something new without a clear pathway for execution is probably unlikely to be successful, in my personal opinion.
Sorry, I had a question. Is there any thought of how any additional green fees, regardless of how it's collected, interacts with the GET? Like, is consumption or revenue from the GET likely to decrease? I mean, there's a finite amount of dollars a visitor will spend, right? Whether it's on fees or goods or whatever. So is that a thought that there's going to be some kind of reduction in spend?
You know, so I think that's a really fair question that I do not know the answer to. And I think it would be worth exploring. I do feel like we find ourselves in a moment due to COVID where visitors have displayed an interest and ability to spend a lot more to come to Hawaii before they even leave. I mean, with tests and the like. So, you know, I think there's some maybe anecdotal hinting at that there wouldn't be too much effect on GET, but I don't know that.
Seth, do you have some thoughts on that?
I mean, I just think Sale asked an incredibly difficult question.
Yeah, I know.
And that we don't really know. I think there is evidence. There's lots of evidence that people have a budget for a vacation and they stick to it. So what we have seen as hotel prices go up, spending in other areas goes down. So to that, it would kind of support, it would at least support your idea that, you know, we are dealing with a fixed, but most visitors have like a fixed vacation budget, and you take one from one thing, you're gonna, or if you're taking one thing will take it from another spot because it's a fixed budget. That's the only thing I know.
Yeah, I just thought that maybe as a part of, if we're going to recommend a study, then that would probably be something that would need to be studied.
Yeah, I would say with respect to we have a pretty strong baseline of research, looking at other systems, looking at the legal pathways, looking now at the sort of specific policy pathways. And I think probably we've built a good foundation. And I guess, Murray, to your point, and Sale to yours, like there's probably some granularity of analyses that would need to be done on specific policy proposals at this stage that would give us clarification on what is the most achievable. Because we've spent the last 3-4 years, I think, haven't we, Eric, building some of the fundamental building blocks of this and how to adapt it to Hawaii's unique situation. I'm also just personally of the opinion that, you know, we know that we have about a decade to act before the biggest impacts of climate change will be irreversible. So we do have a ticking clock here, and the policy process is never a fast one, but I think we have enough to implement a green fee at this point, personally, having worked on it for half a decade now, closely with Eric and others. That's not to stymie additional research or studies, Sale or Murray or others, but I think some of that could be done during the process to inform the process of what a policy could look like, rather than to get it done and then take the steps to think about enabling it or implementing it.
And Jack, just out of curiosity, you see is a green fee dissimilar from like some kind of levy, like coastal climate mitigation risk that would be levied on like a property tax? Like that's completely different. I mean, because what I'm trying to understand is, on one hand, we're trying to build up a coffer to adjust to a changing climate, right? And trying to do that. And so on the other hand, which I guess it would, the property tax levy or some kind of levy on like, we have to adjust to the fact, we have to make all these infrastructure investments. Would that be included in your green fee, or is that just another way? I guess my question is, what's
Right now.
this is the strategy. The strategy is on green fees on visitors. Is that right?
The way I would personally characterize this is that you have the green infrastructure and then you have the built infrastructure.
Uh-huh.
And a visitor green fee focuses on the green infrastructure.
Got
That
it.
is the
Okay.
natural ecosystems that communities and the tourism sector rely on. The built infrastructure and some of the proposals that have been put out there for a carbon tax or for a climate policy, would focus on that. Because I'm looking at Alton's background, for example, and you think about that and a meter of sea level rise, there's a lot of built infrastructure. It's going to have a huge price tag. And I think the Climate Commission has done quite a hefty analysis on what that looks like. And that's I think an even bigger number because of the cost of moving things and where our infrastructure is at and some of its aging, nature, et cetera.
Thank you.
Eric,
I do. But frankly, there will be overlap there. I mean, in very broad brushstrokes, I think we're in the hole as far as where that revenue would come from to do any of what we're concerned will happen by 2050 and sooner. If any of you have a home on the shore, on North Shore, I don't have to sell this to you. I think as for what Jack was saying earlier, I agree, and I think I would just layer on that I think we've done enough foundational research to agree that something needs to be constructed. How that is oriented and scaffolded and designed and built, I think those are the kinds of questions that still I think would need to be answered. So if there was, in my humble opinion, if there was legislation that could commit to establishing this kind of mechanism that was tied to providing funding upfront to think through how it will be done properly, for me, that seems like a very logical way to go.
Okay, so
just one. Sorry, I just want to say, and this goes to the whole commission, is like, beware of recommending studies. There's so many studies at the state, right? So like, if you're going to recommend studies, be super specific about what you do, because that is one way that legislatures kick cans down the road, is to study it more.
Exactly.
True. And yet I do feel that we should be adding some specificity into how this could be implemented successfully. So I think the commission needs to have more discussion about what exactly our recommendation would be. At the moment, it seems to me that we might be successful, or we might include in our recommendation that this is an urgent issue that the legislature should take up, and they should figure out, they should basically create some mechanism to start collecting this, and with a timeline that allows them to work out some of the details.
That'd be tremendous.
Okay, any other discussion before we let Jack and Eric go today?
Thank you.
Thank you very much. Really appreciate your return visit and the additional information that you have provided us. And if you do collect any additional information, particularly about what is happening in other jurisdictions, let us know.
Certainly will, and sure Eric and I feel the same way. We're just honored and humbled to be here and to present some of this to the Tax Review Commission. Thank you very much. And we'll be in touch and available anytime for additional conversations or questions the commission may have.
Thank
Thank you
you.
very much for your time and
Thank
for
you.
having us.
Thank you.
Hello.
Well,
So as we return to our agenda, I'm wondering, maybe we should ask Alton to talk about the Simpson Bowls, and then we'll get back to the presentation on pension taxes. Would that work for you, Alton?
Sure, and I'll keep it very brief. So, as we all know, the budgeting process includes both analyzing sources of revenue as well as, managing expenditures. Unfortunately, the TRC's mandate is to recommend revenue and tax policy, and not really look at the other side of the equation, since the expense side is outside of the purview of this commission. But as noted in my memo, 2 past TRCs have both recommended establishing this Simpson Bowles type of commission. And I'd like to also suggest that we do the same, but instead of just having a general recommendation of us forming this commission, I think what was suggested earlier on a number of occasions is if we can be very specific about what we would like them to look at. And I think in the 2015 to 17 TRC, they mentioned looking at the government employee pension and health fund liability. And that's mandated by law. So I think that'll be a good start. And any other specific areas that we would like this commission to focus on.
Thank you.
Any questions?
I'm just thinking in terms of addressing the public worker retirement benefits. I believe since the 2017 Tax Review Commission, the legislature has passed additional legislation that requires them to make an investment of an annual required payment into those. And the idea is that for both the pension and health trust fund, they're trying to build it up so that it is supported in large part by its investments, not just taxpayer dollars. So I'm just wondering, given that, whether there would be much of an appetite to address the so-called unfunded liabilities for retirement costs. But having said that, I think that there are a lot of other issues that a commission could look into, including some of the things we were just talking about in terms of addressing climate change and other essential costs of government that we don't have budgeted right now.
Yeah, that's a good idea. I thought I read somewhere that the recent legislature did not fund deferred funding of one of the benefits. I forget what, or possibly both. They kind of just kicked the can down the road.
I think it was the health premium. Wasn't it, Scott? Was it pension? Was it
I think
both?
they deferred the required payment
Yep.
at the start of COVID.
Open.
Okay, any other questions, comments, Murray?
Yeah, but just a general one. This wasn't high on my original list of things I was focused on, but I think it's one of those things that, especially as I read the memo, it just sounds like it's good practice. It's smart. We've got all these unfunded liabilities. It comes up in the news every few years. They kick the can down the street. So I think this is kind of a no regrets kind of recommendation thing. It doesn't require a lot of extra work beyond, I mean, the memo is pretty good, a pretty good core for that. So for my part, I feel like it's one of those things that's kind of an easy thing to recommend. Whether they choose to listen to us or not, we can't say, but I feel like it's a fairly easy thing to recommend. Just my 2 cents.
Yeah, that's true, and it is kind of best practices. Yes, and maybe we can just add a few other items to the questions that such a commission could be looking at besides pensions.
Great.
Okay, thank you, Alton.
Thank you.
Now, Dr. Caracavalli, please continue.
Thank you very much. So this is much shorter, I promise. So that the first presentation included way more background information. So now that we kind of have the basics under hand, let's focus specifically on the issue of the exempt pensions and other retirement income that were recommended to be repealed from the exemption. I just want to again point out the same disclaimer applies. Any views, any analysis, interpretations that are expressed here should not be attributed to the Office of Tax Research and Planning or Hawaii Department of Taxation. So the federal rule for pensions and annuities is that it's partially taxable. So there's certain parts that are not taxed, like the as I mentioned earlier, the contributions that are made to employees' retirement system they are not normally taxed, but certain aspects of contributions, if they were taxed, then these will be reduced from the eventual tax liability once the retirees start withdrawing their pension income. And for Social Security benefits also, it's not the total amount of the Social Security benefits that are taxed. Generally, it's up to about 50% of your benefits are taxable, but it can be up to 85%, again, based on income level. So if your income level is more than 34,000, then the total of 1/2 of your benefits and all your other income, then your taxation rate might be different. But the question is not what is done at the federal level. The question is these federally taxed Social Security benefits and federally taxed pension income are exempt from Hawaii taxes. So that was the issue at hand. And the biggest of these is the public retirement system, the employees' retirement system, which has more than 135,000 members currently. So I'll give some statistics in terms of the pension income receivers in Hawaii, and also Social Security benefits recipients in Hawaii, and finally also take into account the fact that the contributions to the ERS are already taxed currently by Hawaii, which is not taxed at the federal level. As you remember, 2001 and 3 Tax Review Commission were concerned about the equity and fairness, and they wanted to kind of remove this unfair treatment of the pension plans, the defined benefit plans, from the defined contribution plans, such as 401ks, IRAs, or 457, and you name it. But they also said it should be done with great care and after additional analysis. The thing that they suggested was, first, it should be phased in, and it should not apply to people who retire before that date in order not to penalize the current and prospective retirees. This might obviously encourage some people to retire before the due date arrives, and it might have other ramifications. But beyond that point, with the fairness in mind, they did recommend a phase-in period. And the 2005 and 7 Commission also, yes.
Can I just ask a question for clarification? I recalled that they recommended a delayed phase-in. I did not recall that they said don't tax people who are currently retired at all. Is that what it said?
That is correct.
Okay, thank you. Sure.
Yeah, so it's slightly different. You're right. So the 2005 and 7 Tax Review Commission are suggested, had also fairness and equity concerns. They also had the concern that given the fact that these are fixed income people and have made all these decisions already, they might have even made decisions of where to live and where to retire already. It would be unfair potentially. And as a compromise to ameliorate the effect of this change on those receiving tax-free pensions, that let's exclude the base amount, for example, $50,000, anything beyond that amount would be taxed to remove the effect entirely for those very small pensions at least. The 2015 and 17 Commission did not recommend such a base exclusion. And in addition, they also wanted the conforming to the federal treatment of Social Security income as well. So this was not touched by the previous tax review commissions. They were just dealing with pension income, whereas the 15-17 Commission bunched Social Security income to be subject to taxation as well. And they just suggested a 5-year lag in terms of its implementation, but in that regard, it was slightly different from the previous ones. Now, I already talked about the micro simulations, but what is going to be different here is that the Hawaii adjusted gross income is going to change once we start taxing the pension income that was exempt, or if we also add Social Security benefits that were not taxed. So the new highlighted in blue Hawaii adjusted gross income is now going to add additional income. And so it will be a higher Hawaii adjusted gross income to be subject to taxation, but we will not be taxing the current rate of contributions that are currently taxed. So there are two offsetting effects, one relatively smaller, the contributions, than the pension income that is not taxed currently. And then that way we do this for all the residents and then come up with the result. So this is what we have seen already. So the first experiment does look at the just the basic recommendation that what happens if we tax the pension income that is taxed at the federal level, but also tax it here in Hawaii without any base exclusions. Not the Social Security benefits, just the pension income, given the unfairness that was pointed out that it's treated differently from the 401ks and other defined contribution plans. So the impact of this is that remarkable, obviously, $220 million for in tax year 2019 data. If we take the Council on Revenue's forecast in projecting individual income tax changes in the future, about on the average $255 million of increase in tax collections. The one little note for non-residents, and then my analysis will focus on residents, is that the public law does prohibit any state from imposing an income tax on the retirement income of any individual who is not a resident or domiciliary of that state. So this is something to bear in mind. So my analysis focuses mainly on the residents, and the 220 million that it is here is that the 256 million increase is due to just the taxing the formerly exempt pension income, and then minus 35.6 million for the lost ERS contributions that are not taxed anymore under this framework. So the net effect is 220 million. The second policy experiment is what 2015 and 17 Commission recommended. What happens if we tax both pension income and Social Security benefits to the full extent and there were no base exclusions? The figure goes up to 363 million. So remember, it was 220, so we add another 140 million to Hawaii individual income tax collections. The third one is using the 2005 and 7 Tax Review Commission's recommendation of having a 25,000 per retiree exemption. So they said 50,000, but what it really entailed was if you're joint filers, you would have 50,000, single filers 25,000, head of household 37.5. So kind of this delineation based on filing status. Then the impact is much smaller, obviously. It's $42 million. And finally, a bit more modest exemption amount, with half of that, would be having a budget impact of $107 million. Now, before we delve into how this affects everyone, I just want to point out some of the characteristics of the pensioners in Hawaii. The most resident taxpayers have single filing status, and however, majority of the resident taxpayers that do report pension income, they are married filing jointly. The average pension income, if you look at the averages column here, indicates that the average pension income that is exempt from taxation is $36,798. So this is the income we're talking about on the average. But the total resident pension income that is exempt from taxes is $4.2 billion. Let's put this in context. So this corresponds to about 8.9% of Hawaii net total income. So it is a sizable amount. The other thing to note, I mean, one little note here is that the widow group, I mean, although they make only 0.1% of the taxpayer population, they are the ones with the highest fraction relying on pension income, and they also report the largest share of their income that is attributable to pensions, as might be expected, someone being widowed. For Social Security benefits, the average Social Security benefit amount is $17,258. And if you just look at the totality of this, we're talking about $1.9 billion that is exempt from taxes currently, which corresponds to 4% of Hawaii net total income. The same thing is true in terms of filing status. The widowers are the highest fraction relying on Social Security benefits. In terms of the tax exempt pension income and its distribution in different income classes, I want to juxtapose what happens if you look at the distribution if we use Hawaii adjusted gross income, which naturally excludes the pension income and Social Security benefits. What we see is that the majority of the pensioners appear to be in the bottom two income brackets. So either less than 0 to 10,000. And the tax exempt pension income is reported in 113,000 people. So that corresponds to about 18% of the resident return. So given Hawaii's aging population, that's a sizable amount and a fraction of the population that are collecting pension income. But when we switch to looking at this using federal adjusted gross income, which is not the basis for taxation in Hawaii, right? The pictures changes quite a bit in the sense federal AGI does include the pension income and Social Security benefits. And then if you look at the highlighted sections here, you would see that most pensioners are actually in what can be considered as the middle of the federal adjusted gross income distribution. So part of the issue is that what are the certain characteristics of the retirees is that they are not necessarily the top two brackets if we actually consider take their Social Security and pension income into account. Similar thing happens when you look at Social Security benefits as well. So this is not just the pensioners. The Social Security benefits are reported in 16.6% of resident returns. And actually, the higher proportions of upper federal adjusted gross income classes claim Social Security benefits. And the main reason for this is that it's based on age. So the people who are with higher income earners are also in their later stages of their life cycle. But otherwise, if you look at the income distribution, it's again in the middle of the pack by federal AGI. Let's look at the effect of these 4 different policy exercises. Remember, the first one was removing pension exemption. The second one is removing pension plus Social Security exemption. The third one is reducing the pension exemption to $25,000 per retiree, and the fourth one was reducing pension exemption to 12.5%, 12,500 per retiree. So the one thing, obviously, is that in all income classes, again, we're using federal AGI because it represents a better actual income level of the retiree population in Hawaii. While the net tax liabilities have increased all over the world for all of the income classes, what happens is that the tax liability share of lower income brackets increase vis-a-vis the rest of the retirees. And this is mainly because the lower income classes are more likely to depend on the retirement income only. Again, remember, this is income that is subject to taxation, not wealth. So the lower income will be relying most likely on just the retirement income, but would not have additional income sources.
Excuse me.
Yes.
I know that we are losing some people at 2 o'clock, and we are pretty close to that hour.
Okay.
I'm wondering if you could.
I have maybe
and,
2 or 3 more slides, and that's going to be it.
Yes,
Yeah,
and
definitely.
then we can discuss it further at our next meeting.
So I mean, I just because if I just give all these tables, you would just go dizzy, but I just want to make sure that the information is there in case you want to dig deeper. I'm just suggesting that the information is there. I just highlight a few bullet points, but again, I'm more than happy to answer questions next time. I'm aware we're running out of time. But the percentage increases, if you look at how much it increases in terms of the net tax liability, they are higher, disproportionately higher for lower income groups when we do not do any base exemptions. So I want you to focus in the last part of this table where it says percentage change in net tax liability. So the yellow highlighted parts. So the lower income classes, their tax liability increases at a disproportionately higher level because this group is more likely to depend on the retirement income as compared to the other income groups. However, when we do have the base exemptions, we do see, as expected, that the lower income retirees are indeed shielded from the increased tax burden. So the yellow sections for the last 2 columns, these are with the 50,000 exemption and 25,000 exemption. As you can see, the impact is more for those in the higher income groups. So this is kind of taking into account the concerns of the previous tax review commissions. And here I have a summary slide with all the revenue impacts for review. And as I said, I've talked way too much today. So there's much information I provided, and hopefully you might take a look at these, which will be provided right away. And then I'll be more than happy to answer questions maybe next time, and provide further information. Thank you.
Thank you very much. And I'm sorry to rush you through the end. We did have a cover on our agenda today, and these were really excellent. So I hope that we will have an opportunity to review them all when it's posted on the website, and have more discussion on these at our next meeting, which is, I believe, on October 13th. And with that, it's 1:59 and our meeting is adjourned. Thank you very much, everybody.
Thank you.
Bye.